Okay, so you want to run a money laundering ring. Set up a few businesses, move some cash through them, turn dirty money into clean money, walk into a bank with a briefcase full of problems, walk out with a legitimate wire transfer. That's the plan. And honestly, it sounds almost too simple. Because on paper, the demand for this service is infinite. Every criminal on earth, every fraudster, every corrupt official, every embezzler, every tax cheat, has the same problem. They have money they can't explain, and they will pay someone good money to make that problem disappear. The United Nations estimates that between $800 billion and $2 trillion is laundered globally every single year. That is 2 to 5% of the entire world's GDP. If money laundering were a country, its economy would be bigger than Italy's. In the United States alone, roughly $300 billion moves through laundering channels every year. That's more than the GDP of Finland, and authorities recover almost none of it. The conviction rate for money laundering in the US sits around 6.5%. For every dollar laundered, about 93 cents makes it through clean. You hear those numbers and you think, so the demand is massive, the supply is limited, and the odds of getting caught are less than 7%? Sign me up. Here's the problem. Money laundering is not a side hustle. It is a financial services business, one that runs on the same infrastructure as legitimate banking but without any of the legal protections. It has clients, it has operating costs, it has compliance risks, and the product it sells, clean money, requires a level of financial engineering that would make most accountants sweat. Let's start with how it actually works, because the mechanics are a lot more sophisticated than stuffing cash into a mattress. Every money laundering operation, from a corner store washing a few thousand a month to a multinational network moving billions, follows the same three-stage process: placement, layering, and integration. Think of it like a factory. Raw material goes in dirty, gets processed through a series of machines, and comes out clean on the other side. Stage 1. Placement. This is the hardest part and the most dangerous. You have to get physical cash into the financial system without anyone noticing. The problem is that banks are legally required to report any cash transaction over $10,000 to the Financial Crimes Enforcement Network, FinCEN. So you can't just walk into Chase with a duffel bag. This is where Smurfing comes in. You break that duffel bag into dozens of smaller deposits. $8,000 here, $7,500 there, $9,200 at a different branch, each one under the reporting threshold. You use different banks, different branches, different days. Sometimes you recruit people, called Smurfs, to make the deposits for you. 10 people making 10 deposits at 10 banks on the same Tuesday morning. Each deposit looks normal. Together, they've just placed $90,000 into the system. But here's the catch. Banks got smart. They don't just flag transactions over $10,000 anymore. They also flag patterns of transactions just under $10,000. That's called structuring, and it's a federal crime in itself, even if the money is legitimate. So the smurfing has to look random. Different amounts, different intervals, different locations. The more sophisticated the placement, the more it costs to operate. Stage 2. Layering. This is where the magic happens. Once the money is inside the financial system, you need to move it through so many transactions that nobody can trace it back to its source. Think of it like shuffling a deck of cards. The more you shuffle, the harder it is to find the original order. Shell companies are the workhorse of layering. A shell company is a corporate entity that exists only on paper. No employees, no office, no real operations. Just a name, a registration, and a bank account. You set up a shell in Delaware, another in the British Virgin Islands, a third in Panama. Company A invoices Company B for consulting services. Company B pays Company C for equipment rental. Company C wires the funds to a bank in Singapore. Each transaction looks legitimate on its own. Stacked together, they've moved $2 million across 4 jurisdictions in a week. And here's the thing about shell companies. In some jurisdictions, you don't even need to disclose who owns them. The Corporate Transparency Act in the US tried to fix this by requiring beneficial ownership information reporting. But enforcement is still catching up. In the British Virgin Islands, you can set up a company in 24 hours, and the ownership structure can be buried behind layers of trusts and nominees. Wire transfers are the second layer. Moving money electronically between banks in different countries creates distance. Each transfer generates new paperwork, a new account number, a new jurisdiction. By the time the money has bounced through 4 countries, the original deposit is buried under so much documentation that tracing it requires international cooperation between regulators who may not even speak the same language. Trade-based laundering is the third, and the biggest. The Financial Action Task Force estimates that trade-based money laundering accounts for 80 to 85% of all global laundering volume. Here's how it works. You overvalue an invoice. Say you're importing electronics from China. The real value of the shipment is $100,000, but you invoice it at $500,000. You wire $500,000 to the Chinese supplier. The supplier keeps $100,000 for the actual goods and sends $400,000 back to you through a different channel, now clean, now justified by a legitimate-looking import transaction. Customs sees a normal shipment. The bank sees a normal wire transfer. Nobody sees the $400,000 that just got washed. Stage 3. Integration. The money is now inside the legitimate economy. It looks clean. It has paperwork. It has a story. Now you use it. Real estate is the most popular integration vehicle in the world, and it's not even close. You buy a property with laundered funds, hold it for 2 years, sell it at market value. The proceeds from the sale are completely clean. They came from a legitimate real estate transaction. Nobody asks where the money came from to buy the property in the first place, because in many jurisdictions, real estate agents aren't even required to file suspicious activity reports. Luxury goods work the same way. Art, jewelry, vintage cars, watches. You buy a $3 million painting through a private dealer who doesn't ask questions. 2 years later, you sell it at auction for $2.8 million. You lost $200,000 on the sale, but you gained $2.8 million in perfectly clean, auction-verified funds. Legitimate business investment is the final step. You take the clean money and invest it in a real company. A restaurant, a car wash, a franchise, a tech startup. The business generates legitimate revenue. Your laundered capital is now indistinguishable from any other investor's money. At this point, it's essentially impossible to trace. So what does all this cost? Because a laundering ring isn't a charity. Somebody has to get paid. According to a study published in Trends in Organized Crime, professional money launderers in the United States charge a median fee of 8 to 9% of the total amount laundered. Europol puts the range at 5 to 20%. For cybercrime, which carries higher scrutiny, the median fee jumps to 26%. Let's do the math. Say a client brings you $10 million in dirty cash. At an 8% fee, you keep $800,000. The client gets $9.2 million in clean, usable funds. Your operating costs, maintaining the shell companies, paying the Smurfs, covering legal fees, bribing the occasional compliance officer, eat maybe $200,000 to $300,000 of that. Your net profit on a single $10 million job is roughly $500,000. That sounds great until you realize what you're actually managing. You need registered shell companies in multiple jurisdictions. Each one costs $2,000 to $15,000 to set up and maintain annually. You need bank accounts that pass Know Your Customer checks, which means you need nominee directors with clean backgrounds. You need accountants who can generate convincing invoices and financial statements. You need lawyers who understand corporate structures across multiple legal systems. And you need all of these people to keep their mouths shut. A mid-size laundering operation, serving 5 to 10 regular clients, and processing $50 to $100 million a year, might have total operating expenses of $2 to $4 million. Shell company maintenance, staff, legal, travel, compliance costs, and a reserve fund for when things go sideways. Against $4 to $8 million in gross fees, that's a net margin of roughly 50% in a good year. But the fragility is the real story. Because everything depends on one thing: nobody asking questions. Now here's the counterintuitive part. You'd think that the rise of digital banking would make money laundering easier. No physical cash, no Smurfs, just move numbers between screens. And in some ways, it has. Cryptocurrency laundering hit $23.8 billion in 2022, up 68% from the year before. Crypto mixers, DeFi platforms, and privacy coins can obscure the origin of funds in ways that traditional banking never could. But here's what most people don't realize. Digital transactions create permanent records. Every blockchain transaction is logged forever. Every wire transfer has a timestamp, an IP address, and a compliance trail. The very technology that makes moving money easier also makes hiding it harder. Banks now run thousands of automated compliance checks every single day. Every transaction is scored against risk algorithms. Every new account is checked against sanctions lists, politically exposed persons databases, and adverse media screening. Financial institutions process 3,000 to 5,000 suspicious activity alerts daily. And while 95% of those are false positives, the 5% that are real have brought down entire networks. The irony of modern money laundering is this. The more efficiently you can move money, the more efficiently you can get caught. Let's run the numbers on a real operation. A working mid-size laundering ring processing $80 million a year for a stable roster of clients. Your fee averages 9%. That's $7.2 million in gross revenue. Operating costs, shell companies across 4 jurisdictions, nominee directors, accountants, legal counsel, encrypted communications, travel, run about $2.5 million. You're netting $4.7 million a year, quietly, invisibly, and for some operators, it runs that way for years. No headlines, no subpoenas, just a silent financial machine humming in the background. But the entire thing is held together by one material: silence. And silence has an expiration date. Danske Bank ran $230 billion through a single branch in Estonia for 8 years before anyone looked. When they finally did, CEO gone, share price halved, $2 billion in penalties. TD Bank moved $670 million for 3 separate laundering networks through its own accounts. October 2024, it became the first major U.S. bank in history to plead guilty to money laundering conspiracy. $1.8 billion fine. 1MDB funneled $4.5 billion through shell companies, luxury real estate, and Hollywood film financing across 4 continents. Goldman Sachs paid $2.9 billion. The former Malaysian prime minister went to prison. The architect of the scheme is still running. Every single one of these operations worked, until it didn't. One client gets indicted for fraud. His lawyer offers the DOJ a cooperation deal. Your client hands over your name, your shell network, and 3 bank accounts, in exchange for a lighter sentence. He doesn't hesitate. Within 48 hours, Treasury freezes $15 million in your accounts. 2 nominee directors get subpoenaed. Your shell registrations in Delaware, the BVI, and Panama are flagged. Your other clients hear the news and vanish. Revenue doesn't decline, it evaporates. The infrastructure you spent years building is now a prosecutor's exhibit, and the clock doesn't rewind. Every laundering operation that has ever collapsed ended the same way. Not because the technique failed, because one person inside the chain decided their freedom mattered more than your anonymity, and there is no financial instrument on earth that hedges against that. So if the margins are this fragile, if detection is getting better every year, if one cooperating witness can erase a decade of work in a single afternoon, why does anyone still do this? Because the demand never stops. Every year, trillions of dollars are generated through fraud, corruption, tax evasion, and organized crime. Every one of those dollars needs to be cleaned, and for every laundering network that gets shut down, the clients don't disappear, they just find a new launderer. The laundering fee, that 8 to 20% cut, is not a charge for a service. It's the price of invisibility. The price of making money look like it came from nowhere and everywhere at the same time. And as long as there's a gap between what people earn and what they can explain, someone will offer to close that gap for a percentage. The methods change. Cash in suitcases became wire transfers. Wire transfers became shell companies. Shell companies became crypto wallets. Crypto wallets will become whatever comes next. But the service, making dirty money clean, is as old as money itself. And no regulation, no algorithm, no compliance system has ever managed to kill the demand. The laundromats change. The laundry doesn't. If you made it this far, you now understand how money laundering actually works better than most people who work in banking. This is what we do here on Snow. Break down the economics behind the world's most profitable illegal industries so you understand how they really operate. If that sounds like your kind of content, subscribe and turn on notifications so you don't miss the next one. Drop a comment telling me which illicit economy you want me to break down next. I'll see you in the next video.